So in last video, we learned the money market, what is money supply, money demand, and how can we find equilibrium point, and how the market mechanism will work on the money market so that if the interest rate is not equilibrium interest rate, how the market will move the interest rate back to the equilibrium point. So in this video, we will specifically talk about who will be able to change the equilibrium interest rate. So first of all, we have to talk about the federal government. And so the federal government is the one control the monetary supply, especially the Federal Reserve System. So the Federal Reserve System can alter the money supply through changing the reserve requirements, changing the discount rate, or open market operation. So generally speaking, the Fed can alter the equilibrium rate of interest. So they have superpower. So by increasing the money supply, so the Fed tend to lower the equilibrium rate of the interest. So increasing the money supply, such as reducing the reserve requirement, or they can do the changing the federal funds rate. So what is the federal funds rate? So that is the total. So that is the interest rate for interbank reserve loan. So when the bank injects reserve from the banking system via open market operation, so the interest rate on the interbank loan is most directly affected. So if they inject money, so interest rate will go down as well. So those are the possible way to affect the equilibrium rate of interest. So by decreasing the money supply, such as increasing the reserve requirement for the banking system, or try to withdraw the reserve from the banking system, and so increasing the interest rate of the interbank reserve loan. So that all will changing the money supply, decrease the money supply. So the Fed tend to rise the equilibrium rate of interest. So that is how the bank will, how the Fed will changing the interest rate.